Hey everybody, it's Prashant here. Welcome back to my channel and thank you for joining me today. Today I'm going to be doing a little bit of a summary, a recap of what's going on over in the market, go over some juicy data that I've got prepared for you, and show you where we are today and how it compares to where we've been in the past. And also I'll talk about what I'm going to be doing, as in how am I investing, what I think is going to happen next, and so on and so forth. So let's dive in right after you smash the like button for the YouTube algorithm and subscribe to this channel. Seriously, guys, let's get me to 500 subs. All right. So let's first talk about stocks. Stocks have obviously taken a tumble basically since the start of January of this year. We had the worst January for the S&P 500 since the financial crisis of 2009. Luckily, stocks have recovered a bit in February, but the S&P 500 is still down about 2% from where it started, or where it ended 2021, I'm sorry. Even now, we keep seeing small conviction-less rallies before the stock market falls again, and this cycle is repeating itself over and over and over again over the last few weeks. So in particular, I wanted to talk about a few specific tech stocks that recently reported earnings. So let's do that. First up, we had Amazon report their earnings, and you can see right here, they beat earnings. Let me scroll down a little bit here. So you can see that they beat earnings 580 per share versus 357 expected, and they missed revenue a little bit. They came in at 137.4 billion instead of 137.6 billion dollars. So earnings, they beat expectations. However, they missed revenue expectations slightly. A large part, I think, that they had so high earnings per share was that Amazon has a 20% stake in Rivian, and Rivian IPO'd last quarter, I believe, and it gave Amazon a push. Bottom line is, even though Amazon missed revenue, investors rewarded Amazon, and its shares are up 14% over the last week. Obviously, Amazon is doing well, and people continue to believe in the company. Apple was a similar story. Let me pull that one up for you guys here. Apple was a similar story, and they beat expectations on revenue, on profits, and earnings per share. Again, Apple's stock did really, really well on the news and is up 10% or so since the earnings call. This just goes to show you that Apple is a master at manufacturing, and they were able to increase revenue even in this time of chip shortage and other supply chain shortages. Microsoft, similar story. Microsoft also beat earnings and revenue, I believe. Microsoft stock is up as well, about 5% above where it was when it announced earnings. The one company that I want to say actually missed, they had like a major miss and a major oops, is Facebook, or Meta Platforms, if you want to call it that. So let's take a look at that here. Let me change the screen right quick. Okay, here we go. So earnings per share, a miss, 367 versus 384. Revenue was up a little bit, but here's what really happened. With Facebook, they saw a decline in daily and monthly users, 1.93 billion daily active users versus 1.95, and monthly active users, monthly 2.91 billion versus 2.95. And I believe this is the first time that Facebook has seen a decrease in active users, and the markets did not like that. The stock has cratered. It's down about 28% since earnings were reported. Last June, Facebook had a market cap of $1 trillion. And as of now, as of yesterday, Facebook had a market cap of just under $600 billion. So $400 billion of shareholder value wiped out in a single day. It was unbelievable. Anyway, let's move on to the housing market. So housing in the country is on absolute fire. I know from personal experience that houses are getting more and more expensive, as I'm currently looking to buy a house for my own family in the greater Seattle area in the suburbs. I intend to make a detailed video on this soon, but if you want to know exactly what I'm going through, go ahead and check out my TikTok. I'm going to leave a link in the description, or you can just search for me by name at Prashant Kuchi, and you will see what I've been facing on my TikToks over there. Anyway, let's take a look at this chart here by the St. Louis Fed. So this chart shows us a it's a chart that shows the median sale price of houses sold in the United States, and the data goes back all the way to 1960. So I'm just going to zoom in and just let's talk about the recent history from like 2019 or so. Let me just zoom in, maybe a little bit more. Okay, here we go. So median housing prices in Q1 2019 were $313,000, right? So just under $315,000. As of Q4 of 2021, this number has increased to just over $408,000, an increase of 93%. I'm sorry, an increase of $93,000 over a period of just 3 years, an average increase of 10% year over year. This is a really high increase rate of increase, especially considering that in the typical long term, real estate goes up, but only about 3% annually in the United States. So right now we're seeing housing is increasing really, really fast, and in specific markets such as the Seattle area, which is where I have the most recent and personal experience, I'm seeing that housing has increased 20% in a single year. So housing is absolutely on fire right now. Low inventories, low interest rates, and in some areas, high salaries from employees in tech, and also speculative investment from individuals as well as corporations are driving prices very, very high at the moment. So next I want to talk about inflation, right? Inflation data just came out for January at a super high 7.5%. I actually posted about this as soon as the data came out on my Instagram stories this morning. If you want, you can go ahead and follow me there as well. Again, at Prashant Kuchi on Instagram. Now, this is the highest inflation rate we have seen since 1982. Take a look at this chart here. This is again from the St. Louis Fed, and this shows us inflation data. I'm sorry, the chart's not up yet. Here we go. Okay, so this shows us inflation data going back again to 1960. And you can see that, we've had periods of high inflation, of course, but the last time we had inflation at above 7%, but 7.2%, is in this time frame at like 1980, 1982. And look at this here. It was declining inflation, right? We had peak inflation in 1980 of 13.5%, and then the US went into a recession. So all of these gray sort of bars here on this chart are showing us US recessions. So we had a peak of 13.5% in inflation in 1980, and then we went into a recession, and that's when we saw inflation at about 7.2% back in 1982. And before that, we saw rising inflation in the late 70s. When we had rising inflation of the 70s as well. Now, we're not currently in a recession, but we are seeing increasing inflation. So we're in this section of the inflation chart, right? Again, in this section, if we go back to the 1972 time frame, and then again 1976. So looking at this data, going back all the way to 1960, every time we've had peak inflation above 5%. So check this out: 1970, 5.8%. 1974, 11%, 1980, 13.5%, 1990, 5%, right? So every time we've had an inflation peak over 5%, we've had a recession. 1970, 1974, 1980, and 1990. So this does not mean we will have a recession, but the data seems pretty ominous. We've had a recession every time that inflation has peaked over 5% since 1960. So data looks pretty ominous. I'm not saying that there will be a recession, but there very well could be. Just if you go by historical data, that's what the data trend is telling us. Now, next I want to talk about the US personal savings rate. So this was another very interesting metric, right? So I'm going to pull up this chart again here. Again, this is from the St. Louis Fed. So this is the personal savings rate. Now, since the 2008-2009 financial crisis, right here, so I'm going to actually zoom in here so we get rid of some of this older data for a minute. Right. So this is the 08-09 financial crisis, right? Since then, the US personal savings rate has consistently been between the 5% and the 10%. In fact, ignoring a few blips, like if I go back and zoom out all the way to 1960, ignoring a few blips here and there after the 1985 mark, Americans typically have had a 5 to 10% savings rate since 1985. This makes sense. The this changed in 2020. Let's see this, right? We see this huge spike up here where all of a sudden we see the American personal savings rate went up to nearly 34%. By the way, look at this. It's very interesting. We don't remember this, but we were technically in a recession in February, March of 2020. We went into a small, very brief, basically a 2-month recession, and then we came out of it. But anyhow, at that time, American personal savings rate went up all the way almost to 34% in April of 2020. This makes sense. People had just started getting their stimulus checks of $2,500, and everyone was stuck at home when they were to spend the money. Now, savings rate has fallen again in the more typical like 7% rate. I think this can spell trouble for individuals, right? Considering the fact that inflation is super high right now, if we get even a smaller recession and people lose jobs, I think this can get painful really, really fast for people. Now, one more related factor that I want to talk about is US household debt. Take a look at this chart. This is from the New York Fed. So here we go. So right away, you can see that the majority of the US household debt is in the housing debt, which is basically to say that majority of US household debt is mortgages. This is that blue area in this chart that you can see. And up above in the orange, kind of orange area, rust colored, that's your non-mortgage debt, right? So what's interesting to see is that total debt actually went down after the 08-09 crisis. We see total debt going down. Now, this makes sense to me. This is not necessarily a very good thing. It could just be that a lot of people lost their houses, so maybe they didn't have mortgages anymore. It could also be that people just didn't have access to a lot of debt or to a lot of financing from banks because the banks were unwilling to give it. In the last 8 years or so, since like 2014, we can see that once again, this household debt is starting to go up. Now, in the last 8 years or so, this makes sense to me, right? As millennials are getting older, they're starting to buy houses. Of course, their mortgage debt, like right here, you see this even from 2016 onwards. You can see that mortgage debt for the millennials is starting to go up, which makes sense. They're buying houses and they're borrowing for those houses. Now, the really interesting thing is that non-housing debt is actually increasing a little bit more than before. So what this means is that people are borrowing more on their credit cards. And what do people spend money on credit cards for? It's discretionary spending, right? So in general, what this means is that people are feeling pretty good overall about their jobs, about the economy, and they're spending more on discretionary stuff. Of course, inflation is up a little bit more as well, so things are costing people a little bit more. So that adds to that. The other thing that goes into this is like automotive debt, like for cars. And we know car prices have gone up significantly over the last year or so. You go at the dealership, you have to pay over MSRP, so you're borrowing more money. And that goes in that orange section of the non-housing debt, right? So people are borrowing more and more money, and that's not necessarily just housing stuff. Again, this is all good if people can pay it, right? But if they hit a stumbling block, this could be very, very difficult for consumers. As we all know, credit card debt especially comes with very high interest rates, and if people lose jobs and are not able to pay it off, this can like balloon out of control very, very quickly. So, okay, now that we've seen all of this data, here are my thoughts on what happens next and how I'm personally investing. Now, again, this is not investing advice. Please do your due diligence and make your investing decisions for yourself, what makes sense to you. But I just wanted to tell you what I'm doing, what I'm thinking. So first up, stocks. Honestly, in my opinion, stocks are behaving a little weirdly right now. For example, a company like Facebook, they lose 25% in value because they had declining user engagement. But at the same time, Amazon missed revenue targets and is rewarded with a 15% pop in stock prices, right? It's kind of strange. But overall, though, stocks have continued to be a little weak. We see some rallies, then some corrections, and this is happening on a day-to-day and a week-to-week basis. And I think this will continue to happen till we see what the Fed is going to do. We just don't know what the Fed is going to do over the next few quarters. Now, the next Fed meeting is on March 16th, when they're widely expected to increase interest rates. What remains to see is how much. Now, they can increase it 25 basis points or 0.25%, or they could go really aggressive and increase it 50 basis points or 0.5%, or I guess they could go even higher, who knows. But investors are trying to gauge exactly how much Fed is going to increase rates for the entirety of 2022 and even 2023. Investors have already priced in a Fed interest rate hike of at least 0.25% or 25 basis points. But investors want to know what's going to happen through the rest of the year. And I don't think the Fed has actually made up its mind. I don't think the board members have actually made up their minds on this. My thought is that on this meeting on March 16th, they're going to increase rates by 0.25% and then wait and watch and see what happens. And then on the next meeting, again raise interest rates and then again wait and see what happens. If inflation starts to cool off just by doing that much, maybe they can hit pause and wait out 6 months or up to a year to see what happens next. And if they want to, or they feel like they have to, they can increase rates at that point, or maybe even go back. But I generally don't think we're going back. It's either going to be a pause or they are going to keep going. So when it comes to housing, here's the thing. We're seeing historic hot sellers markets because of a few reasons, in my opinion. First, housing inventory is low. We are just not building enough houses across the country. We have a lot of demand as people are buying more and more houses as millennials are growing older, but we're not building enough houses. So obviously, supply is low, demand is high, so prices go higher. Then the second thing is interest rates have been low for the last 2.5 years and historically low, but now we know that they're increasing. So a lot of people are rushing to buy their houses and lock in these low interest rates while they still can. Same time last year, mortgage rates were about 3% for a 30-year loan. Some people even got sub 3% interest rates. But right now, interest rates for a 30-year mortgage are starting to push 4% already. And it's only going to go up from here, especially as the Fed increases its interest rates. Now, in specific markets, I think actually, hang on. Well, as interest rates rise, I think there might be a little bit of a cooling off because as soon as interest rates rise, people's buying power shrinks, right? Because as you are paying more interest, your monthly mortgage payment goes up, and people cannot afford that bigger and bigger mortgage payment, so they go and look for cheaper or smaller houses. So I think a little bit of a softening in prices might be coming later this year across the country, I think. However, I think in certain specific areas that are absolutely bonkers, like Seattle, California, maybe even Austin, Texas, I think we may not see as much of a softening in the real estate or housing market as we may see in other areas around the country. So third, I want to talk about inflation and what I think happens next. Now, previously on this channel, I've said that I believe that inflation will start tapering off or even reducing later in the year, September or later, basically Q4 of 2022. Now, a lot of this depends on what the Fed does, to be honest. If they increase interest rates rapidly, we may see inflation taper off quickly. The trouble is, we may also see a recession. It's hard, right? The Fed has to walk this tightrope between a rock and a hard place. You want to reduce inflation, but you don't want a recession either. We saw the data. Most times, or every time we see inflation above 5%, we've seen a recession. So that's what the Fed has to manage. They want to hedge off extra inflation, but at the same time, they don't want a recession. They don't want people losing jobs, which makes sense. Now, fourth thing that I talked about is when it comes to personal savings rate and US household debt, I hope that people are building those emergency funds. I hope that people think about reducing some discretionary spending, maybe cut off a few subscriptions or whatever it might be, and pad those emergency funds. Look, things are going pretty well in the job market right now. Wages are rising, unemployment rate is less than 3.5%. That's all great. And if things continue to be this way, you'll probably be okay. But the cost of things is rising, inflation is rising. And if we hit a recession, as soon as we may see that, because the data is telling us that, if we see a recession and people start seeing layoffs, if they don't have those emergency funds padded and built up, that could be really, really painful. So I really hope that everyone is working on those emergency funds, or they already have those built. If you don't know, an emergency fund, just to tell you quickly, is basically 3 to 6 months of all of your expenses in basically easily accessible in cash, basically in a bank account, in a savings account, not in stocks, because the stock market can go down anytime. So I hope that people are building and keeping up on those very important emergency funds. So Okay, so let me tell you what I'm doing in terms of investing. So here's the thing. I believe time in the market is far better than timing the market. I've said this time and time again on my YouTube, on my Facebook, on my Instagram, and on my TikTok. Time in the market is much better than timing the market. So the very first thing that I'm doing is that I'm not selling. I have not sold a single stock in over a last year and a half, I believe. And the second thing that I'm doing is that I maxed out my Roth IRA for 2022. Earlier in the year, in December, end of December or early January, I released a video of how I'm investing in 2022, and I said I'm building a cash position, and that if I see a correction of 10% or so, I'm going to go and put that cash in, and that's exactly what I did. I did it within my Roth IRA, and I bought the dip. Now, of course, the market has since dipped even more, but I'm okay with that. I know I got into a cost basis that I feel pretty good with. So I'm not selling those holdings at all, and I'm just happy to sit tight on it. The next thing that I'm doing is that I'm continuing to dollar cost average into the S&P 500 within my 401k plan every week through my payroll deductions. I don't believe that I can accurately time the top and the bottom of the market. I think that's impossible. So my intention is to keep putting money in every week so that I keep growing that portfolio slowly. And lastly, I'm not investing any excess money. I do have a small cash position that I'm trying to build up every week as I'm making money through my day job, and I'm trying to build up that cash position one more time. Now that I've exhausted the cash position I had at the end of the year of 2021, I'm trying to rebuild that a little bit. And I think again, if there is another juicy dip, I might go into the market again and buy some more. But I'm not spending extra money or not investing extra money into the market like I typically do. My thought is that I've already done a lump sum investment at the start of the year, and even if I miss a little bit of a run up, I feel okay. And honestly, this is my emotion talking. It may not be the most rational thing. The most rational thing would be the dollar cost average, but I want to see what the Fed does in this March meeting and how stocks react to that. And if there is a dip at that point, I would go ahead and invest that money into the stock market as well, the S&P 500 as always. So that's what I have for you guys in today's video. Thank you so much for watching. I hope you enjoyed this video, and I hope you enjoyed this live format. Let me know in the comment section down below what you think of this, and if you would like to see more of this. And also let me know what you think is going on in all this craziness in the stock market, the housing market, the inflation, and tell me what happens next. Also, once again, check me out on TikTok if you have that. I recently went viral on there with a single video getting over 6 months of watch time, which I am just blown away about. And I think that's really, really insane, and I'm really proud of that. So if you want, go ahead and follow me on TikTok. You can see the link in the description down below, and if you can even search it, just at Prashant Kuchi. Also go ahead and follow me on Instagram, and go ahead and check out my Facebook page, where I also post about these videos and some tidbits on personal finance. All right, that's it, everybody. Thank you so much for watching, and see you next time.